Alrighty, so we should be live here. Alrighty, so we should be live here. We'll wait a little bit, get some people on board. This will be recorded, which will be nice as well, so we can upload this. So we'll get up my screen here, which should be nice. Move that across a little bit. That should look pretty solid. Alrighty. So we should be live here. We'll wait a little bit, get some people on board, make this feel this will be recorded, which will be nice as well. But pretty much today, based on what everyone was saying in the YouTube community section, we're going to be touching on a few little things here. So the most voted thing, just from memory, was time and price, which was a good topic. So it should be time and price. So we'll wait a little bit, get fairly high up there. And we also had some things about the market maker buy model. Pretty much today, based on what everyone was saying in the YouTube community really section, just want to get into. We're going to be touching on get into it straight away. Start having a chat, and we're going to use the London session to start. From memory was in terms of last week's price action, right? So similar to the last Masterclass, I've got the points here, right? So we're going to go through some of this stuff, but then I'm also going to go pretty much today, based on go through exactly what you're seeing, and then later on I'll make this available to you. Really just want to get into probably the same content as stream, get into straight away Uber Drive, start having a chat, and we're going to use the London session to start in terms of last week's price action, right? So similar to the last Masterclass, I've got the points here, right? So we're going to go through some of this stuff, but then I'm also going to go pretty much today, based on go through exactly what you're seeing, and then later on I'll make this available to you. Really just want to get into probably the same content as stream, get into straight away Uber Drive, start having a chat, and we're going to use the London session to start in terms of last week's price action, right? So similar to the last Masterclass, I've got the points here, right? So we're going to go through some of this stuff, but then I'm also going to go pretty much today, based on go through exactly what you're seeing, and then later on I'll make this available to you. Really just want to get into probably the same content as stream, get into straight away Uber Drive, start having a chat, and we're going to use the London session to start in terms of last week's price action, right? So similar to the last Masterclass. Try this. How about now? How about now? Is that better? There we go, yeah. I had the YouTube tab open at the top, so that's all good. Thanks for letting me know. Otherwise, would have kept going. But yeah, cool. So pretty much today we're going to be going through this. Right, so this PDF, and what I'm going to do, I'll just fix this up for you guys. I'll put this up on a Google Drive link so you guys can see that, right? So I'm going to try and make this fitted to the screen. We can probably go in a little bit more. But yeah, time and price was the main thing that we wanted to talk about today, right? So a lot of people voted for that. I pretty much cover everything. So I'll put up the poll there just so I know what to focus on the most. And then from there, I kind of come up with these things that you guys can download, which is fair enough. Really, I want to talk about this session. And I want to start by talking about the London session. Most people, like some people still ask me about silver bullet timeframes. And for me, or if you're in Australia, obviously you're probably trading the London silver bullet, which obviously is 3 to 4, right? Fair enough. 2 to 5, right? And this is all New York time, so the charts here are set to New York time, even though I'm from Australia. So what I can do, I can actually move this up a little bit, just so you can see the bottom. So we'll get that up a bit. But all my charts are set to New York time. That's probably the first thing to keep in mind, right? Now, on this particular day, what was quite interesting is that when I opened up the charts, and this was probably at about this point, roughly somewhere about here, this is before, the London Open session, I straight away saw all this accumulation. Now, whenever I see accumulation, I'm always thinking the power of three. I'm always thinking the power of three, right? So what we're going to kind of use time and price to go through is we're going to talk about obviously the silver bullet sessions, the macros, when you should anticipate things to happen, how you can actually trust your trade that you're in, or how you can trust that the market's going to do something in certain time frames, because time comes first, then price comes second. So I've back tested macros, I've done all of that. And really, you could have very little knowledge about what's going on a larger time frame, and you could just base your trades off macros, something important happening in macros, and you'd still have a pretty good win rate, and you'd probably still be profitable, right? So we're going to kind of touch on that. Got some new faces in the chat as well. Some new people here. Thanks for joining in. But yeah, we're going to get started now. So with the masterclass, we kind of covered this. That's the basis. I don't want to spend too much time on this. I feel like most people already know that. All right, so we're going to leave that there. If you want to look at that in your own time, that's fair enough. But the main thing that I want to talk about is to have trust that windows in time will allow price to move as you want them to. Right, without time, you've got nothing. We know, of course, that fair value gaps, order blocks, breaker blocks, all these PD arrays, yeah, they're probably going to be respected outside of the silver bullet window. But if you want high probability, always stick to those key time frames. And in terms of my strategies, it's always based on time. Time is like the key element that I'm working with there, right? So this here, what you're seeing, this is exactly what happened the other day, right? And if you're in my Discord and you're in this YouTube chat, let me know. But you'd remember, right? So the price was probably sitting roughly about here, maybe a bit less. It was before 2 o'clock. And I mentioned that I was looking at the power of three, right? And I was looking at the midnight open price. Now, I'm not too sure how familiar with everyone is with the midnight open price, but it is an important thing to keep in mind. So the first thing when we're talking about time, and I might just make this a little text box here, the first kind of key concept that I want to touch on is midnight open price. You might already have a good understanding of this. If not, we'll go through it. But essentially, think of midnight open price as a magnet, right? Price likes to return to it. It likes to just touch it, just go above it, just go below it, and then move in the desired direction that was initially made, right? And let me kind of explain what I mean by that. Now, let's say you get your charts, and I'm on the 1 minute time frame. So just grab your cursor. There's the 12 o'clock candle right here, I believe, and I get the opening price. I'll mark that out in time, and that's the midnight open. So on this particular day, I was seeing something like this. The market was like this. That's all I saw. So I saw accumulation. I saw all these Asian highs, which we'll talk about. I like that kind of liquidity. I saw midnight open, and then I saw some kind of abrupt move to the downside. So I saw quite a few elements that seem to be lining up with a lot of time aspects, right? So time is not just midnight open, time is not just silver bullet. There's a lot more to that I've kind of put in this PDF that we're going to discuss today, but we'll start with the midnight open price. So midnight open price, if you see accumulation, and I may have talked about this in the last masterclass, but maybe not that extensively. If you see accumulation at midnight open, that's the first sign that you probably can have some kind of power of three element setting up, right? So midnight open is the first element of time that's important for me at this point, right? The second is this time in terms of liquidity, right? So what I'm going to say is there's time-based liquidity, and I haven't specifically talked about this in that much detail, but time-based liquidity is crucial. And all I mean by that is liquidity formed at key time frames. Now, what are those key time frames? Let's go through it. If you're trading London session, time-based liquidity would be things like Asian highs and lows, or previous day highs and lows, or previous session highs and lows. So time-based liquidity is based off sessions. It's also, and I might make a little point here, it's also based off macro periods. So there's a macro just before silver bullet. I believe it's 2:33 to 3 o'clock, right, in the morning for New York time. You might have a swing high or low formed during that time. That becomes time-based liquidity. So that time-based liquidity can be used as a target. It can also be used as, once you take that out, then you've rated liquidity and you can look for your typical market structure shift and return, right? So time-based liquidity, and I might just draw a little arrow because that's all related. It's all based on those important swing highs and swing lows. And again, I always come back to the fact that the market only targets two things. This is exactly what ICT says, and one of the key points that's stuck in my head. It targets imbalances, or it targets swing highs and swing lows. If you've got equal highs and equal lows, even better. If you've got a big imbalance and you've got a swing high or swing low nearby, even better, right? But that's time-based liquidity. So in terms of time, you've got midnight open price. That's going to be important for the power of 3, right? You've got time-based liquidity. So London session, you want to look for Asian highs and lows, and maybe macros. So there's a macro from, I think it's 2:33 up until 3. So we'll talk about that as we kind of go along. But that's what we're kind of working with, right? Now, in this kind of image here, I've mentioned time-based liquidity and the midnight open price, or the midnight opening price. Trendline liquidity there. So when I look at this image, or when I was looking at this, there was multiple aspects of time that came together for me. Number one was the accumulation at midnight open. Number two was that we left time-based liquidity to get taken. And number three, we had the manipulation move, and this is probably important. We had the manipulation move before the start of London open session, which said to me, okay, if I'm going to target this time-based liquidity, and we've had what we need, the accumulation at midnight open, and we've manipulated before London open, maybe London open session, or the start of London open session, will provide an opportunity to go long. That was my thinking, by using time. Without time, I don't know any of this thing. I don't know that these are time-based liquidity points that hold a lot of liquidity. I don't know that price is meant to accumulate at midnight open. I don't know that a manipulation move potentially before the start of London open might set me up for a time-based entry during London open to take out that liquidity. But with time, I do know that, right? So that's why it's really important for me. Then we come down, we rate this sell-side liquidity, we'll talk about that. But really, the importance of midnight open is it's a magnet for price. And these 2 points are probably a good rule to live by in terms of trading. It's not the be-all and end-all, right? But if you can buy below midnight open and sell above midnight open, you're going to prevent a lot of, I guess, silly losses or silly trades. So if you apply that here as well, midnight open price is here. We've come below midnight open, good buying price, good buying range. Once we come above it, then we can sell or look for sells. Now, if you come above midnight open here, does it make sense to look for sells? Well, potentially, and we'll talk about that. We could have looked for sells after we took out that Asian liquidity, but we'll talk about why maybe it wasn't the best idea as well, and we'll refer to the midnight open price here, right? So midnight open price, we used it originally to get that accumulation. That's the first time we used it. Then we manipulated to the downside. In doing so, we swept all of this sell-side liquidity, right? So we swept sell-side liquidity. After taking out that sell-side liquidity, we then had some kind of market structure shift to the upside, right? So this is like a typical, 2022, entry kind of model. And have a look what happens now. Have a look what happens now. Try to kind of, in your head, picture where you could enter to go long, entering from at least 2 o'clock onwards, and try to picture where you could enter from, because there's probably a few different PD arrays you could enter from depending on your strategy, right? So we accumulated here, we left all this trendline liquidity, so we'll frame the picture. I'm going to call that trendline liquidity. I love trendline liquidity. If you're in my Discord, you'd know I love it. If I see trendline liquidity, and especially if the Asian highs, which again is time-based liquidity, I know it's going to be a great target, because retail traders, support and resistance traders, they see that as resistance. Once it's tapped twice, they're going to draw a trend line here. Once it taps again, they're going short, and they're making money for a bit, but if they haven't mitigated their stops, they're going to get stopped out here, and that's flooding into the market. Stop losses equals money, equals liquidity, equals a great target, right? So we rated sell-side liquidity. We had a market structure shift. I'm going to draw out this bullish gap here, right? That bullish gap. And this is on the 1 minute time frame, right? So depending on how you trade, depending on what you look for, things may become a bit more clear as you start to move up time frame. So for example, 5 minute. Have a look at the 5 minute time frame. If I move that bullish gap to right there, and have a look at what price is doing, right? Rating sell-side liquidity. When do we rate it? Before. So we're having the manipulation leg in a key time frame before the start of London Open. That then sets up a trade for London Open. So I'm using time as a factor there. We rate these equal lows, we tap into this order block and this busy or bullish fair value gap. Now, I want you to look at time and look at the time that we return to this gap and what we do after it. And look at the time that we return to this gap and what we do after that, right? There's a point in time that I kind of refer to as volatility that occurs in a few different sections of time, right? And I'm going to go back to the 1 minute just so you can kind of see this and we can elaborate on this a little bit more. So expect some kind of volatility with certain time frames. Now, a lot of people already know this, but you might not, right? So we're gonna go through it. Now, we know, of course, right, when the market opens, there's going to be volatility. So if you're trading the London session, this is what I'm looking for. I'm looking at these times. We know what 12 o'clock's used for. That's midnight open price. What do you reckon 1:30 is going to be? If you've watched some of my other videos, you might know. If you know, send it in the chat. I'm looking at it. Why do you reckon I might be looking at price at 1:30? So I start at 12 and then 90 minutes later at 1:30, why might I be anticipating time to do something important? If you know, say something in the chat. If not, all good. But it's something to do with this. That'll give you a hint, right? And that there stands for the quarterly theory. So 1:30 is actually the start of the second quarter. It's actually the start of the second quarter. So essentially, at each time frame that might have something important, I anticipate a change. And if that change is presented, then I look for an entry model to then execute off, right? Another time, I'm going to illustrate this too on the charts, is 2 a.m., which is the start of London Open. And I encourage you to backtest this, forward test this, but have a look at the first 15 minutes after 2 a.m. See what happens with price. Then the same thing for 3 a.m. because that's the start of the silver bullet, right? And again, I encourage you to backtest, forward test this. Have a look at the first 15 minutes, 10, 15 minutes after actually entering that time period and see what kind of volatility you get, right? So this is another time-based factor. These are all important elements of time, right? All important elements of time here, and they kind of match up to what you're doing. So let's apply these. Midnight open, we've done that. 1:30, let's map that out in time. So let's get the candle exactly on 1:30. What happens at 1:30? What happens at 1:30? 1:30 onwards, right? The first, 15 minutes or so. What that tells me is that we've returned to this, and this being the 5 minute bullish fair value gap, and we've actually rejected back to the upside from there. So for me, when I'm looking at this, I've got my accumulation, I've got my manipulation. I've got the power of 3 setting up before the silver bullet and before London Open. I've got my trend line liquidity, that time-based liquidity, there ready to be taken, like ready to be absolutely smacked, which you see happens in a second. So all the time elements leading up to when I'm going to enter match to go long. Then at 1:30, the start of the new quarter also matches to go long as well, right? So every time a new quarter starts, and I might move this up so we can actually expand a little bit on this, and you can take a screenshot later on if you want. This will also be in the PDF, like I've summarized this too. But I anticipate that potentially the start of a new quarter will yield something new. That's all I'm trying to say. So if I just copy this, start of new quarters may yield new price action. Nice is fair enough too, but new price action. So the start of the new quarter, whether it's at 1:30 or the next one's at 3 o'clock or the next one's at 4:30, I anticipate, right, that potentially maybe that's when some kind of reversal might start to show, right? And in this case, 1:30 we do, right? We start to return to this. We sweep this level of internal sell side on the 1 minute. We tap into this 5 minute busy and we reject off that, right? So that there, again, these are all stacked confluences based on time. So you want to use time not just for, oh yeah, I'm going to enter a trade in silver bullet. Fair enough, right? But you want to use time for all these other aspects to give you more confidence to enter that trade and to take a position, right? So I think it was around this point I caught it in my Discord. Now, could you enter before London Open? Yes. Do I recommend it? No. Unless that's your strategy and that's what you do, right? Because have a look at what happened at 2 o'clock, right? And we're going to talk about this, 2 a.m. and 3 a.m. So 2 a.m., let's have a look at what happens here. I'm going to draw this out. The first like 15 minutes or so, so 2 o'clock's here. That's roughly the first 15 minutes. What happens in the first 15 minutes? What important information do we get? And if I just draw that out here, price returns again, right, to the busy, and it raids some internal sell side liquidity. You might be like, okay, fair enough. Because again, we've rated that sell side there. We've rated this sell side here. Okay, fair enough. Well, how do I know it's not going to go down? How do I know that this bearish fair value gap's not going to hold it and we're not going to continue lower? The key is to look at the reaction once we sweep liquidity. That's the key. That is the key. So whenever you're kind of curious, because people have asked me like, how do I know that it's not going to keep going down here? How do I know it's not going to take out this low? Well, all of this is pretty strong. That should be pretty strong. Like that's a magnet of price. Relative equal highs, trend on liquidity. That's like a massive magnet, right, to go higher. But if that's not enough for you, then what I'd encourage you to do is, even on the 1 minute, have a look here, for example, right? Once we take out that sell side, do we like aggressively push lower? Well, not really. That's the candle that takes it out. We have one more down close candle, and then look at that impulsive move up. The next impulsive move up, guess what happens there? This now becomes an inversion fair value gap. So inversion fair value gaps are a really good way, right, to read price. Really, really good way, right? Because what happens here is this. You see that, you've got your analysis, right? You've got to stick to your analysis because you've got all these factors, right? All these factors here that are impacting that, you know, your bias is probably going to play out. You see this inversion fair value gap happen after you've rated liquidity on an internal scale, which is even better because you've generated more energy here. That's the way I like to think of it. You've got an inversion fair value gap. Where do you enter from? Right here, candle close. Now price doesn't always have to return to the inverse, but if you're entering multiple positions, then you could enter a position here, and if it does return, enter again. If not, you enter here, stop loss below the low. If you wanted to, right, 1-to-1, you could take a partial, but ultimately you should be able to target the top of that trend line liquidity. Ultimately, you should be able to target a 1-to-2 quite easily, and it takes what, 1-2 candles or 2 minutes to do that. And just observe, right, for example, how like we actually aggressively trade past these swing highs here. And the reason for it is because of this. It's time-based liquidity, and that liquidity is relative equal highs and trend line liquidity. And you've got the power of 3 playing out. And you've got the fact that the new quarter started some new price delivery. And you've got the fact that we've rated liquidity internally right on the 15 minutes, right? And you've got the fact that we disrespected this inversion. So when you start reading price, you need multiple stacked confluences, and that'll give you confidence to enter trades. That'll give you confidence to enter trades and to form a bias too. So if you ever see accumulation at midnight open being an important price, like an important time, I would anticipate the power of 3. Now, if you see a manipulation move, then you see trend on liquidity, and guess what? We've been bullish. Like if you've been seeing the NQ chart lately, we've made all-time highs. The actual order flow, like on a higher time frame, on all time frames, like large, is bullish, right? So by you taking this trade as well, you're going with a higher time frame order flow, right? So that's an opportunity to go long there, and that will be an opportunity to take from the span of 2 to 3 o'clock, right? Again, 2 to 3 o'clock And we're going to map this out too. That's the first hour of the London Open session, right? 2 to 3 o'clock. 1:30 to 2 is like the half an hour previous, but let's draw this up till 3 o'clock here. So that there is like the first hour. It's not even silver bullet. So some people just trade silver bullet and they'd kind of be in this section here waiting to see what price does. So let's kind of talk about what price does during the silver bullet. Because right now we just entered silver bullet time frame. Now, at this point, it would be kind of fair to say that the main objective has been met. Like that there is the main objective. When you're trading London session, if you take out Asian sell side, so there's Asian sell side liquidity points, you kind of want to target the opposing liquidity, right? So that opposing time-based liquidity has now been taken out. We're at all-time highs. What happens from here? And just watch what price does. In the next hour or so, it's not that tidy, right? So the next hour up until roughly about here, it's not that tidy, right? So we accumulate quite a bit, and I could imagine people get very like chopped out in price. Very, very chopped out in price here, right? But the way I see this accumulation phase is then just, I guess, developing energy, developing power, taking enough people's stop losses, that's the way I like to see it, to then continue in the overall direction, right? So think of it like energy, think of it like power. And good work in the chat there as well. So that there would have been the first hour's trade. This here is the start of a new quarter, right? So I'm going to say start of quarter 2. So that's the start of the quarter 2. This here is the first hour, right, of the London Open session. And then we're going to map out now, get rid of this stuff, map out the silver bullet and talk about maybe what entries you could have gotten, or even if you got an entry between the silver bullet and also the first hour, somewhere around there. So that's your first entry, right? We'll get rid of that. Midnight open price. Look at what the actual candles do. And we're actually going to extend this out in time to the AM session because it becomes important there too. So midnight open price is not only important for the London session in terms of time, but also sometimes for the AM session if you're trading. So just looking at that, look how we just like wick past the midnight open price. I'm going to draw that bullish fair value gap. Look how we just wick past it. Right? Look how we just wick past it. Wick past it once, wick past it a little bit of a body, wick past it again, right? But we're struggling. We're struggling to move lower. So again, what did I say? Buy below midnight open, sell above. And the fact, right, that we're just tapping below and rejecting is a good indication that maybe the order flow is going to continue. And look what happens here. We tap here, we have this little kind of rally up, and we get very close to this swing high. We get very close to this swing high. That's kind of giving the false illusion to people that maybe it's a double top, right? Maybe it's a double top. We get very close again, right? All that's doing, that's just building liquidity. This is like engineered liquidity. And this is also time-based liquidity, right? This liquidity here is formed at 256. That there was formed at 220. That's the first hour of the session. That's time-based liquidity. You can then target that if you're trading the silver bullet, right? Because it occurred before the silver bullet time frame, if that makes sense for you, right? So let's talk about a potential silver bullet trade. You'd have all this as a framework. You'd have the fact that we've wicked under midnight open multiple times as a further framework. And then what I like to tell people is this: when you enter silver bullet, what are we doing more of? Are we respecting the bullish PD arrays or are we respecting the bearish PD arrays, right? The fact that we can't go any lower than this is a good sign that we're probably going to head up, right? And the fact that we start here disrespecting these bearish fair value gaps is an indication that maybe, right, maybe we're starting to head up. So this bearish gap, that gets disrespected, that gets inversed. This bearish gap also gets inversed. So how do you enter off that? How do you enter off that? Look what happens here. We break past it, we trade back into it. We break past it, we trade back into it. See that accumulation? That is what you want to see if you return to an inversion fair value gap. It's not a bad thing, it's a good thing. It's accumulating positions to go further up. So where do you enter from? Enter from the tap here or enter from this? Where do you put your stop loss? Say you got filled maybe here. I'd place my stop loss below this down close candle. That's below this inversion fair value gap, right? And that allows price again to retrace, but doesn't really need to go anymore. So you can take partials at this high. You could go for a 1 to 2, whatever you kind of need it to do. So bit of tricky price action during the London session, and you'd have to kind of use your inversion fair value gaps to execute on that trade there, right? But I hope this kind of makes sense how we're putting all these concepts together. So we're using time in multiple aspects, right? So we'll go back to our PDF just so we can stay on track. I always kind of find a way to to go a little bit off topic, but I like to merge in other concepts, other things that kind of make sense, right? So we've talked about this, that's fair enough. We mentioned the quarterly theory, and this is on a 5-minute chart, by the way, so you can see how that looks. Anticipating a change in price delivery at 1:30. Does it happen? Yes, and this is a further confirmation. So in terms of time, we've talked about time-based liquidity. We've talked about time in terms of midnight open and how you should have accumulation at midnight open for the power of 3. So when should the power of 3 occur? That's when it should occur, right? Midnight open should be accumulation, and that should be an Asian session. How can I use the quarterly theory? At the start of each new quarter, if price starts to show a change in direction and it suits your overall bias, there's your confluence, and that's using time in the terms of the quarterly theory, right? The next is the volatility at 2 a.m. and 3 a.m. and the initial opening of the London session. So we mentioned that here, 2 a.m. the first 15 minutes. 3 a.m., let's get that, that's here. What happens in the first 15 minutes? What does that tell us? We return to midnight open and we rejected from that. So expect some kind of volatility, right, in the first 10 to 15 minutes at 2 a.m., at 3 a.m. The same thing happens at 9:30 when the session opens for New York, right? Similar kind of thing, not on a big scale here, but still expect some volatility. So how you can kind of use this as well, another important tip is like if you're in a trade and it's just before 3 a.m. and you've like really mitigated your stop losses quite a bit, just be mindful that you may get stopped out and it may continue in your direction. So I've noticed the volatility is more at 3 a.m. compared to 2, about an hour after that session opens, right? And I mentioned that here too, right? First 15 minutes, it's like a volatility injection. It's just something I've been back testing, something I've been forward testing, and just another confluence you can kind of add. And I've got the example there for you guys so you can see a bit later on, right? Now here's something I want to talk about. Here's something I think that's going to be really, really helpful for you. And this is time and concepts. Time and concepts. So now we're linking time and price. And there's something I want to call the concepts occurring on multiple time frames, because we know that that price and the ICT concepts are fractal. It's a fractal concept, right? You can see fair value gaps on the 5-minute, the 10-minute, the 15-minute, the 1-minute, the 30-second, the 15-second, on anything, the daily. Same with any PD array, right? But what I'm going to do, I'm going to leave this here, and I'm going to actually get a new chart, right? Just so we can get a fresh chart and we can see things clearly. And we'll come back to this one a bit later on, right? So we'll get rid of this. And we're going to go back to that session, which was right here. Now, let's go to replay. Let's go back here. And let's talk about the 5-minute time frame. So the 5-minute time frame tells you quite a bit, right? If you're trading in the 1 minute, the 5 minutes always a good one to look at to see how you're reacting out of certain imbalances and fair value gaps, and the list goes on. So again, just to recap, we saw the accumulation, we saw the manipulation. I'll just do this quickly. And then we saw, or we anticipated, right? It did play out, but we anticipated the distribution, right? That's the distribution phase. When we came down, when we manipulated, we took out equal lows. We also tapped into this bullish fair value gap. And in doing so, we also tapped into this candle, which is an order block, right? So we respected a few kind of PD rays and we displaced from that with some aggression, right? Cool. So on the 5-minute time frame, we've got the power of 3. I'm pretty sure that's pretty like self-explanatory. You can see that. So at this point, when you have the manipulation and you reject, so probably with this candle here, that's when I'm thinking, yeah, okay, power of 3 is probably definitely in play here. When am I more confident about that? When price can close above this zone here. That's when I'm a bit more confident, because this could still hold price to go down, right? But once we can close above that, we'll have some aggression up. then I'm a little bit more confident. Where am I even more confident? Once we have not midnight open, 2 o'clock open, and we come back down, right here when we reject, that's where my full confidence would be in this trade if you're in it, right? That will be a time to enter. And again, you can enter on the 5 minute too. You could enter right here. And where would you put your stop? Just move below this low. Where would you put your TP? At that swing height. So 5 minutes fine, but again, I prefer the 1 minute just to refine my strategy. So again, this occurs on the 5 minute, but look on the 1 minute time frame. And here's the little thing I want to talk about now and spend a bit of time on, because this is something I've got a few examples of now, right? So I'm going to kind of get those up for you in the masterclass points, and I'll get those up. Look at how you've got the accumulation and then manipulation here, and look how you've also got this. I'm going to do this in a different color, different blue color. What's this? What's that? And then also, what's this? Isn't that also accumulation and manipulation, but on a smaller scale? So am I saying, you're saying to me now that accumulation, manipulation, distribution can occur in all time frames? Yes. Just like PD arrays can occur in all time frames. And the reason I'm bringing this up is because I've noticed this is like an A++ setup. A++ setup. When you've got the accumulation, manipulation occurring on the 5 minute, great, beautiful, right? We saw that in the last chart. But when you've got an even smaller power of 3 occurring on the 1 minute time frame, and that power of 3 actually raids liquidity, being Asian session liquidity, that's like an A+. That is what I define as an A+ raid. So there's going to be a couple PDFs about this, and I don't think I mentioned this in the Discord yet, but this is something I'm going to talk about, and I'm going to continue to forward test it. That is what I call an A+ raid. So I'm using the fact of time and the fact that PD arrays and ICT concepts can occur on all different time frames, and looking for it to occur on different time frames. For me, right, to get that confidence that, look, we're definitely going up here. We should be going up here because we've got 2 power 3s, and the power 3 actually raided the liquidity from Asian session. So I'd encourage you, let me know actually who's ever seen that. Has anyone ever seen that? Those that look for the power 3, who's seen this before? Who's seen the power 3 occur on a larger time frame, and then they've zoomed in and you notice it occurs on a smaller time frame as well? Send it in the chat if you've seen it. I'm curious. Because this is all about like time being fractal. Yeah, plenty of times. Cool, yeah. Time being fractal. Time being fractal. PD arrays being fractal. Right, so there's so many ways. Like when you guys voted for time and price, I was thinking, how am I going to approach this? Because like there's so many ways to approach it. But I wanted to get an example where I could merge all these concepts of time and price, put that together for you guys, and then build obviously a PDF that you can come back and look at in the future, right? So that there is an A+ raid. Right? That's what I call an A+ raid, and that's using time and the fact that concepts occur on all different time frames, right? Really, really important. So that is what I'm talking about down here. So if I kind of scroll down, and let's go to this one, ICT concepts on multiple time frames. ICT concepts on multiple time frames. So I hope that kind of either illustrated something new or solidified something for you, right? All this stuff here solidified something for you. What to look for, when to look for it, when to anticipate the power 3, when to anticipate volatility in the markets, when to anticipate a change in the state of delivery or a change in the direction of price, when to enter trades, when to look at the markets, when should price be accumulating, what liquidity points, what time-based liquidity points should you be focused on, right? That is all this, right? That's all we're talking about here. And then I mentioned this, right? So obviously that's the A++. And this is just the first segment of this masterclass, right? If you guys have any questions in regards to that, send them in now, because then we're going to go into the next segment, which will be on market maker buy model and sell models, and we'll also talk about macros as well. So if you've got any questions on this, just let me know. Again, this will be here for you guys anyway. These are some good points. But let me know if you got any questions. And that's correct, yeah. Grand Tour Bear, absolutely fractal. Absolutely fractal. And I guess that should give you the confidence if you're kind of curious about like how people enter on small time frames or larger time frames or what works best for you. Trial and error. And then from there, decide what works for you. So for me, I prefer the 1 minute. But again, you can see here that you could enter off the 5 minute off the same concept. It's exactly the same thing. The 5 minute here gave a clearer picture because it gave me that 5 minute bullish fair value gap that I could see there. On the 1 minute, notice how I've imposed that 5 minute busy on the 1 minute chart. And that's exactly kind of what we've done here. So you can use higher time frame PD arrays on a lower time frame chart. I just wouldn't go the opposite way, right? So I wouldn't get like a 30-second, breaker block or fair value gap and then try to trade on the 5 minute time frame using it. I wouldn't do that. But what I would do is I'd get in the 5 minute chart and I'd grab a 5 minute busy and then I'd implement that. So 5 minute busy, I'd implement that on the 1 minute chart and see how the price respects it. Now, here's the thing, guys. And I might even make a little note of this here. This is based on time too. This is another aspect of time which is actually not in the PDF, but I'll talk about it. Because these are all questions I had, right? So I'm trying to answer as many questions as possible, things that I kind of was, curious about when I first started and all the rest of it. So time PD arrays, we know it can occur on all time frames. We talked about that. But here's the next thing, which I just mentioned. You can use higher time frame PD arrays. So you can use higher time frame PD arrays on a lower time frame. But don't do the reverse. Don't do the reverse, that's the first thing. Also, if you used a 5 minute busy, worry about price on the 5 minute chart. And let me kind of explain what I mean by that, right? So we've measured out a 5 minute busy here. On the 1 minute, look what it looks like. It looks like, oh, we've disrespected that fair value gap. Oh no, we're gonna go lower. But since I've actually drawn on the 5 minute, you wanna look at it on the 5 minute. Like you want to look how the candles close on the 5 minute and look how the candle closes on the 5 minute. We don't even close in there on the 5 minute. So that's my advice. And the same thing happens, right? When you're looking at liquidity points, like that is actually an important point. I'm going to move that over here. I think that's important to keep in mind. So we've actually got all these points, right, for time. Who's ever seen something like this, right? And this is also based on that point. Like price is doing this, accumulation, for example, you manipulate, right? You come back down, you have a market structure shift, you might enter a short position, fair enough. And let me just fix that up a bit. But when price comes up here, this might be like a 15-minute fair value gap that you've drawn out. And because you're looking at it on the 1 minute time frame, the price might do this. And you might be like, oh, price is actually going to go lower. Sorry, price is going to go higher because we've disrespected that PD array. But if you're looking at the chart on the 1 minute, and that's a 15-minute fair value gap, what's really important is how it closes on the 15-minute time frame. Obviously, ideally, you want price to do this because that would indicate bearish order flow. But whatever PD array you draw out, the most, I guess, important determining factor is how price behaves on that time frame. So again, yes, price closed out here on the 5 minute busy, but just one last time on the 5 minute time frame, if we look at that, we didn't even close in there. We just wicked. Right, we just wicked, and that reaction there indicates bullish order flow. The reason why price smacks up so high is because of the trend line liquidity and the power of 3. That's all it is. And there's so much money here, so much liquidity, so many stop losses here ready for taking. So enough on that. But I thought I'd bring that up because that's kind of something that I've thought about too. That's not in the PDF, but I think it's an important concept to talk about. Yeah, boy, the PDF, yes, the PDF's going to be accessible. So after this masterclass, I'm going to upload it. I'll do the same thing on a Google Drive. I'll post the link in the community tab and that'll be up there. So you can download it, do whatever you want with it, print it out, do what you like. Grand Tour Bear. I just ended up color coding the time frame PD arrays. Yeah, you know what? I love doing that as well. Sometimes I make like the higher time frame ones a bit lighter and then the lower time frame ones a bit darker. I've got certain colors for like different things too, like the busies, CBs, breaker blocks. So you'll probably see that on my chart. Very similar to ICT, right? But that's kind of what I've done. But it helps, right? It just helps, because otherwise you might be second guessing yourself here, and you might be going, oh, well, it's going down now. We've broken this low, we're continuing, but we're not, because on the 5 minute we've held that. So I hope that kind of makes sense. For those that just tuned in, because we're kind of growing now numbers, we're about 22. Good to see all you guys here. A bit more than last week actually, or the week before. So I think we had 12 on the first masterclass. So the way I see this happening, once a week or once a fortnight, I'm thinking probably once a fortnight, depending on my availabilities, and that'll give me time to not only do the PDFs and make all this content, but give you time for you guys to think of ideas. So the next one, I'll create a poll. If you have other ideas that you want to get covered, let me know, because I can go through those as well. And if you've got any questions, send me a message. I'll get back to you. If I miss you, just send me another one or comment on the video, and I'll be happy to help. So let's leave that, right? Let's leave that. So we just talked about time, and this here is like a summary, right, of how you could take this long position and be confident, right? So time, obviously liquidity points. Different time periods you expect or anticipate concepts to appear. We know concepts are fractal. You get confirmations through the quarterly theory. You execute in a specific window, and you target time-based liquidity. So time is the essence of everything, guys, right? So that's what we're going to do. And again, we talked about the different entries that maybe you got in the first hour and in silver bullet. So you can all look over this in your own time. But now I want to talk about the market maker buy model, and let's just extend that and make that a little bit bigger. So yeah, I just saw your question there. Could you go over how quarterly theory is used during the New York session in the future if we're wrapped up tonight? So we got a bit of time. I think last time I went for an hour and a half. So what I'll do is I'll go through that at the end. If we don't get to it, we'll go through in the next masterclass. But we should be sweet, right? We should be sweet. So the market maker buy model and sell model. Now this one here is an example from very recently. So I'm just going to zoom in a bit, and I'll actually show you on the charts as well. But generally speaking, you're looking for this kind of structure, and you've probably seen this on YouTube, right, all over the place. And people kind of make it more complicated than it needs to be, like way more complicated. All you're looking for is simply this. You're looking for pockets of accumulation, right? You're looking for, in this case, the overall, I guess, higher time frame bias to be bullish, like on the daily and so on and so forth. And this on the 5 minute chart. So you're looking for this, and then you're looking to execute again in a key time frame, right? So you've got pockets of accumulation, you've got a sell side of the curve, you've got a buy side of the curve. And essentially these pockets of accumulation, these are your targets. Again, these accumulation pockets occur in a specific time window, which should be during the Asian session, right? I class the Asian session from 7 p.m. to 12 a.m. just based on what I know from ICT. So that is Asian session if you have a look, and that is also Asian session, and I'll show you on the charts in a second. And what does this look like here? Like, look at this. Doesn't that look like accumulation, manipulation, and then distribution? Doesn't that look like the power of 3? So honestly, the power of 3 is like one of the most important things to understand, in my opinion. One of the most important things, because it applies to the quarterly theory, it applies to the market maker buy models and sell models, and it just generally applies as well, like if you're looking to take a trade. No worries, good to have you here. But yeah, again, if you missed the start of it, no worries, it's always going to be uploaded to YouTube, so feel free to watch it in your own time, and it'll probably be uploaded straight away. So there's no editing here, it's just one take, so we'll see how we go. So that's the market maker buy model. Now if you have a look at the charts, that's the 16th. So what I want to go back to the 16th just to talk about this a little bit more, right? So what you're looking for again is accumulation pockets, and I'd encourage you which time frame to look at. Look at the 5 minute time frame or the 15 minute time frame. That's my advice. So here's what we're looking at right here, guys. I'm going to zoom in a bit and just put it roughly about here. So notice, right, you've got this accumulation pocket. And what I'm going to do, I'm going to mark out the Asian session. So I'm going to go from 7 o'clock roughly here, and we'll just draw like a rectangle, I think. 7 till say 12 o'clock, that's midnight open. That there is the Asian session range. That's where I'm looking for Asian session highs and Asian session lows, by the way. So that's what I mark out in terms of liquidity. And notice during Asian session, we accumulate. That's exactly what I want to see. Even if I'm trading like on a day-to-day basis, I prefer when Asian session's in a range and then we progress from that later on, rather than like a massive runoff in Asian session, because a lot of the time then I've got to wait for later price action. So that's your Asian session. So that's from 7 till 12. I might just make a note of that here actually. So Asian session is 7 p.m. to 12 a.m. just so you know. We've got an accumulation pocket here. Let's go to the next Asian session, the next day here, right? So that's the previous day. Let's have a look. The next day is roughly from here, 7 till 12, I believe. Right, so that's actually in the morning, sorry, my bad. So that's actually in the morning. So let's leave that there. Let's go to the next Asian session here. So let's get rid of this for a second. Let's mark out from 7 on this candle right here. 7 p.m. Let's go to 12. Right. Roughly about there. There's your Asian session. That's your Asian session liquidity, right? So here what it looks like, if we just backtrack that, that's 6:30 in the morning. This here is leading into, right, 10. And I believe this might have been, was it Martin Luther King Day? It was maybe a bank holiday, I believe, potentially. Right, so that's obviously the morning time leading into, you know, silver bullet time frame. But nonetheless, you've got accumulation. So you're looking for accumulation. Asian session, you've also got accumulation down here too. So I'm looking for these ranges. And notice how, like, on this move down, we've left all these relative equal highs here. We've also left all these points here that are unmitigated. All these swing highs in Asian session that are left for the taking. And this swing high here before the massive drop. So in terms of the market maker buy model, if you're trading, you know, the session for London, for example, right? You see price action do this. It's just had this accumulation, it's ran down, accumulation, it's ran down. And mind you, right, have a look at what's above here as well. What's that? What's that? That's perfect as well. So like, you see all these equal highs, these relative equal highs here, accumulation pockets. It's all you're looking for. Now, sometimes it's going to be really clear, other times it's not. It might be like this, but that's the general model that you're looking for prior to the session that you're trading. So if you're trading London session here, you want to see Asian session on that previous kind of session there and the previous day as well. So let's say this is the 16th of January at 250. The whole day, the 15th of January at 250, you want to see the last day. The last day have this kind of structure, if that makes sense. So the last day you want to have this structure, and that way you can target this. Now, you're not going to be able to target that in the London session solely. You might have to hold on to the trade, or you might use this later on in the AM session, right? So having a look at price action here, what do we get right at 3 o'clock? Have a look. So again, I mentioned at 3 o'clock, you get that volume and volatility injection. That there is what I'm talking about. See that? Massive, massive. And I remember on this particular day, I was anticipating a run up, but I wasn't anticipating this. What that kind of led me to believe was this. We had this section of almost price doing not much. We had this manipulation to the downside. You might be like, well, what are we getting into? What are we manipulating into? Well, we're taking out this swing low here. So we're taking out this sell side liquidity. And I believe on the 30-minute time frame, there was an imbalance here that price returned to, right? And what do we do? First candle on the 3-minute, on the 3 o'clock time frame, sorry, we manipulate to the downside. After that, what do? We start to rally back up. Now, is there an opportunity to go long here? Let's have a look. Let's go back to the 1-minute time frame. Because the whole point, yes, you can identify the market maker sell model and buy model, but you might be curious how you actually execute based on that. So let's have a look. I went through this in another video, I believe, right? but you have this fair value gap here, which would have been your entry point. This would have been your entry point. Now, for those that are still here, I'll give you a little bit of source. This is something I'm working on, and those on my Discord would know because you've been here for a while, or those that are just tuning in. How price behaves in fair value gaps, and I'm not just talking about, oh yeah, if we close below 50%, or you know, oh we should just tap into it. Like, yeah, fair enough. But what I'm talking about is this. A rule that I'm forward testing and back testing at the moment, right? And once I've got more data on this, I'm going to make a PDF again and probably make a video on it again. But I've back tested a little bit and forward tested quite a bit. If price closes below, right, 50% of the fair value gap, demand that price doesn't close below 50% again, right? This is a little point for you, right? And this is a bit off topic, but I thought I'd throw this in, right? So if price closes below 50%, in this case, it closes outside, demand that price doesn't close below 50% again. So we close below 50% on this bullish gap, you can see that, and we close below it. Do we return past 50% with the candles, with the bodies? We don't. That is what you want to see with fair value gaps. Now, let me just apply that to the rest, right? Let me just show you the rest of the price action here, right? So have a look at this one. Have a look at this one. And let me just get up the Fibonacci. What are we doing? What are we doing? Right, let me just show you, right? That's the fair value gap right here. Now, what did I say? If price closes below 50%, and in this case it closes outside, in this case it closes below 50%, you want to demand that price doesn't close past 50% again. And yeah, you might argue, oh, it's closed a little bit, but you see what I mean? Price is using that now as support. Now, if we continue that theory for a bearish scenario, and let me just give you a little bit extra on this, a bearish scenario, right? Let's take this fair value gap, for example. Well, let's take this one. And you might be like, oh, wait a sec. Price closes above, and then we return to it again, we close above 50%. Now, here's the only reason why. It's only because of this order block here. So this is what I've been back testing. The only time this doesn't work, and where you might need to consider other factors, is when there is an order block resting above. So what I mean by that is this. These three candles here, they are an order block. This is technically also an order block, right? But these are an order block. They're the last candles before a shift in structure. Fair enough, right? This is also a high probability order block. I don't know if I've talked about that, but it's a high probability order block because there's a bearish fair value gap that lines up with it. So we know the market, when it swings back up to retrace to fill an imbalance, it probably is going to want to tap into this order block and into this green candle here, which could be considered an order block as well, right? Now here's the catch, right? If there's an order block resting above, then you demand that price does not close above 0.5 of the order block. So 0.5 is consequent encroachment, but it's also called median threshold, which is what ICT calls it in terms of an order block. So fair value gaps is consequent encroachment. Now it's the median threshold. So let's just grab our Fibonacci and grab this candle here. So price, yes, we disrespect this, but we should not breach the 0.5 level of this candle. We shouldn't, right? So if you have your stops up here somewhere and we breach that, I'm out. Bye-bye, I'm out. Because we should start to respect that. And look what happens. Look what happens with the bodies. So you can't make this stuff up. You can't make this stuff up. That's like algorithmic. The bodies stay underneath and the wicks are doing the damage here. So I thought I'd kind of throw that in there. A bit of fair value gap kind of reading of price. But a little bit off topic, right? We're talking about the market maker buy model. So again, this is how you'd enter. Like you'd enter from this fair value gap. If I extend that across in time, it taps back into that again. You could enter from that fair value gap too. You get a small partial and probably stopped out back at break even. But this here would have been your entry. Again, using silver bullet to take the position higher. So if we then go back to the 5-minute time frame, that's where we enter from, right? So let me get rid of this. We enter from that bullish gap. Where do you target? Like, it depends what you're doing. If you're a long-term holder, then you can hold above this high. If you want it to hold for the rest of the session, then you hold above this high. That is when the buy model is completed. So once you take out the original accumulation, that is when the buy model is completed. Now, from this swing high to that swing low, that's the dealing range. Notice how the accumulation's at the top of that dealing range. That's what you want to see. That's what you need to see. Whether or not there's accumulation here or here doesn't matter, but you need that top accumulation to be very close to other buy side liquidity to further that bias that you're going to take it out, if that makes sense, right? So here's your market maker buy model, right? This is the sell side of the curve. That's where the accumulation pocket should be. Here's the buy side of the curve, right? And when do we take that out? We take that out during the silver bullet. Again, time being an important factor for us when we're looking to execute these trades. So just going back, here's what you see in terms of the market maker buy model. Right, so this is one example, right? There's many others. Let me show you one more. You've got the original accumulation. You've got price stepping down. You've got this. I'm going to leave this highlighted, sorry. That there's important. Have a look at that. The final move lower is important, because you might be saying to me, well, Ruben, like, well, how do I know it's not going to keep going down? The reason I know, or how you can know, is that you've had the power of 3 here. The power of 3 has rated sell side liquidity and tapped into a 30-minute busy, and that's happened during a key time frame. Again, time is your friend. Time is not your enemy. Time is your friend. Price moves back to the upside to target the original accumulation. That means the market maker buy model is complete. So this, again, is on the 5-minute time frame. I like that because you can see things more clearly and it puts things into perspective. Here's what we saw, accumulation, the original, right? This is our focus point. That's what you want to focus on. So if you go back in your charts, focus on this. Do your own marking out of the charts, mark out those PD arrays, mark out where you could enter from. That's what you want to focus on, because that's what occurs during a key time frame. So that's your market maker buy model. And have a look at this one, right? This is what I showed you before, but I didn't actually go to the 30-minute time frame. So notice the original accumulation, same trade. Original accumulation, manipulation. We take out sell side, tap into this imbalance. The way that we take out liquidity is a power of 3, which makes it 8+, and then we distribute later on in the session, right? So again, notice the move down. It happens at 3 o'clock. The time again is at play. Sell side's taken. This is all going to be there for you guys when I upload this. And then observe this one. This is like perfect. For those that trade Forex, have a look at this one. This is beautiful. Beautiful example of the market maker buy model. Beautiful example. So notice how it doesn't always have to occur extremely cleanly, if that makes sense. It doesn't have to occur like this. The market maker buy model can also be like this. So again, this is on the 5-minute time frame. Look at that. This here on Euro USD, it happens on Forex too, right? And probably on gold, I'd assume. This is on the 1-minute chart. Look at that. Now, this, we might as well talk about quarterly theory, right? But this is based on the London session, and we'll extend this then to the New York session. If you're still here, we'll talk about that, right? If not, have a bit of a look later on. But notice what happens with price. Notice what happens with price. And have a look what happens from 1:30 to 3, and also what happens right here at 2 o'clock. So if you had to visualize 2 o'clock, I believe right here is 2 o'clock. Right there is 2 o'clock. Now, remember I mentioned that 2 to 2:15, 3 to 3:15, like the first 10-15 minutes, that'll kind of do something. That'll have some volatility. That's what I'm talking about. So you need to have an understanding of the power of 3 to understand the market maker buy model. You want to see accumulation during Asian session or in the previous day. And ideally, you want to see accumulation pockets leading into where you're trading. So let's assume you get here. The charts would be right here. This is when, London Open session starts. If you see that accumulation there, that's beautiful. That's beautiful for the market maker buy model, because then you can target those accumulation highs. This, right, where do you enter from? Have a look, right? Have a look at this. if you wanted to enter from silver bullet, you could enter right on 3 o'clock. You could enter right on 3 o'clock from this bullish fair value gap. I know it's a bit hard to see. Or you can enter here before, right here, right there. Maybe there's some SMT divergence, right? Maybe that occurs there, you can see. But this is the market maker buy model. Now, the reverse happens for the sell model. So what I'm going to do here, I'm just going to draw something up just briefly, just so I can illustrate it a bit better. So you're looking for accumulation pockets, right? Let me just fix this. You're looking for price to step down, potentially accumulate again. And then what you want to do is this. At this point right here, you ideally want this move to occur in a key time frame. So this move, which is your Judas swing, you want the Judas swing to occur at a key time frame. And this is all a part of the market maker buy model, because you need to know when it's going to reverse. You want that to occur from 2 o'clock to 3 o'clock, or at the start of a new quarter, right? That's what I'd suggest. And then again, what happens after that? We then distribute back to the upside, taking out that original accumulation, which is up here. That's when the buy model is complete, right? So that's the market maker buy model, yeah? Here's an example of the market maker sell model on a larger time frame. Have a look at that, study that a little bit. This is on NASDAQ on the 4-hour time frame back in, it's probably, I'd say October, November, roughly about there. So study that. Notice how you've got that original accumulation. Now this is on a larger time frame. Again, concepts are fractal. So what I suggest is you can see these accumulation pockets, and if you drop down on a small time frame, you'd be able to see that. So essentially what I've got here is that once you actually come up and you raid this buy side liquidity, again, accumulation, manipulation, raiding buy side liquidity and tapping into a high time frame PDRA, you then get a market structure shift. At this point here, this is when you're taking advantage of the sell model, right? That's when you're taking advantage of the sell model, and then you're trying to execute shorts, right, during key time frames. So if you see this play out, right, and you're at the top here, you've already had the shift down, you've respected that after taking out liquidity, right? You've had this shift down. Now you're sitting here, you've shifted down. Any rally up, I would treat as suspect. Any little rally up there, I'd treat as suspect, right? That's what I would personally do. And that way you can fade that. So when you have a rally up, you wait for that rate of liquidity. You wait for that shift. You wait for the return in that key time frame, on a smaller time frame, of course, and then you can execute a short position, because you can see if you get this right, if you get these things right, you could be holding this trade all the way from London session, right? And I believe I took this trade, but I only took it here. I only took it at 1 to 2 or 1 to 2.2, somewhere around there. But if you wanted to, you could hold that trade all the way to the top of the accumulation, if that's the type of trader you are, right? So that's what I recommend. Get used to seeing these in the market. Go back and back test these things, right? Take advantage of the move, and you don't have to take advantage of the first part of the move. That's the thing, right? So there's the first stage and there's a second stage of distribution and redistribution is what ICT calls it, right? So number one, number two, there's two opportunities, first and second stage, to get involved in the markets. Not always, but often, right? Having a look at this, that's probably your first opportunity, this run here, and that's for the London session. And this, once we raid that sell side, this is now your second opportunity. So often in the market maker buy model and sell models, there's going to be, I guess, many opportunities to enter the market, if that makes sense, yeah? And that's your market maker sell model. Does that kind of make sense, guys? So you're looking for those patterns, and then you're trying to execute at key time frames. You want accumulation to happen in the session before, or the last, say, 24 hours. That's if you're trading on a 1 minute time frame. If you're a longer term trader, then you could see this appear in the 4 hour time frame. So it just depends what strategy you use, right? This would be used as a confluence that you're probably going to head lower. So if you're looking to hold trades, you want to look for a rally up, which is a fake move then. That's your Judas swing, that's your Judas swing, that's your Judas swing. And then look to take part in the distribution move during a key time frame, if that makes sense as well. Now, in terms of all this, guys, does anyone have any questions at all? In terms of either the buy, the sell model, send that in the chat. Any of this stuff, power of 3, or anything that we haven't talked about that you want to discuss? Because I know someone mentioned the quarterly theory, but is there anything else that you guys want to discuss that you've been thinking about that maybe was on my list? So let me just go back and double check. So if I have a look at the list, who's interested in talking a little bit more about macros? Because we had macros there. Let me know. If not, we'll kind of just roll with it. Now, for those that are still here, or for those that are joining, I've got more PDFs, which are not fully ready yet, right? So the ones that I showed you before, I made 2 publicly available. This is going to be publicly available too. But, just summarizing, right? So have a bit of a look at this. Macros, cool, yeah, cool. Now in terms of macros, do you want AIM session, do you want London, or do you want a bit of both? Because we can go through it, that's fine. Because we can do like a couple days of, I guess, back testing. Now these PDFs, right, it's only 5 pages long. My plan is to make a PDF for pretty much each of the topics, right, that I've got in my Discord. So for those that are in my Discord, you know, and this is what the Discord looks like. But essentially, for all these topics here, just so you can see, for all these topics here, I'm thinking of making a PDF for all these topics. So if you join the Discord, you don't have to. I've got free information. I've got information about all these topics. I'm going to be making a PDF for all of those topics and potentially releasing that to the Discord. I may release it publicly too as time goes on, but that's what I'm kind of working with, right? That's what I'm kind of working with. So I've got obviously fair value gaps. I've got order blocks, right? And I've tried to structure this for you guys. So if you want that, you know what I mean? You can get that. And it goes from the most basic concepts to then the most in-depth, if that makes sense. Yeah. So if that's something you'd be interested in, let me know. I can make that available to you guys once that's all ready. So the idea is to have like 20 and then release them as a package, right? So that can be there too. I'm also working on, and someone did give me this idea from TikTok, great idea, a summary of the ICT 2022 mentorship. Now, I'm not too sure how I'm going to release this. I feel like it's probably going to be quite a long video and I'd probably record it in different segments, but probably in the next month that's going to be recorded and that'll probably be posted to YouTube, right? And I'll have timestamps for each of the different, I guess, lectures or YouTube videos. So I've got notes. I've got about 150 pages of notes and I've got concepts. So I'm going to merge that together and summarize it for you. 5 hours, much better than maybe watching the whole thing. I'd still recommend watch the whole thing. Do it. But if you're looking for a summary, I can also make that happen for you, which is fair enough. Cool. New York AIM session. Yeah, for the macros. How about you? Grand Tour Bear. What about you? What macros are you interested in? And we're going to go back to the chart. I'll grab a new chart up and we'll go through the macros. So about 11 people watching now, more of a personalized kind of segment here. Let's start, right? For you, for the New York AM session. Yeah, we'll go through both. So might as well go through both. We'll start with the AM session, then we'll go back to London, then we'll go back to AM session, we'll work through the whole thing. So we'll back test. So when I'm back testing, this is all I do, and I've done this, you get the macro. So 950 to 1010. Now, you could honestly, right? You could honestly just look at macros and nothing else. You could, and I reckon you'd still have a profitable strategy. Now, what happens in this macro? What happens here? Well, we come down, we don't necessarily raid this liquidity, right? But we raid this internal sell side liquidity here. What does this kind of tell me about price? Not too much that I like to see, but if we rated this swing low here, it'd be even better because then we get a rate of liquidity. Now, I'm not too sure what happened here, and I want to kind of confirm it. I want to look at ES because there might have been some SMT divergence occurring there. Okay, so there's not. So for me, it doesn't really matter. But what could have happened if there was SMT divergence? Let me just go back to NQ. If there was SMT divergence between the two pairs, and let's say NASDAQ was making, higher lows, and ES was making lower lows, I'd take the trade on the NASDAQ for a long. So if there was SMT, then I'd consider that. But that's the macro. Now, this particular macro, fair enough. After the macro, you get some important information. So in this particular macro, it doesn't do too much for me. If it rated this seller side, it would, but it doesn't do too much for me. What does a bit for me is just after the macro, where we start to respect bullish PD arrays, right? So that's the first macro. That's the first macro. Second macro we've got from 1050 to 1110. So let's have a look. That's your second macro. What do we get from that? Not much. Not much, right? And here's the thing. Sometimes macros aren't going to actually develop in price for you. They're not going to give you what you want, and that's completely fine. So what we're going to do, we're going to go back to the previous day. Just going to have a look, right? We're just going to quickly go through macros on each session, London and also New York. So this is the next macro from 950, and this one looks pretty good. So 950 and 949, 50, and 1010. This one's good. So during this macro, what do? This is perfect. We raid sell side liquidity. We tap into this bullish gap. We tap into these two candles, which is an order block, right? And what do we do as well? We actually have a market structure shift. Beautiful. So we actually have multiple things occurring in this macro. So this is what I call a high probability macro, where the macro is giving you multiple signatures in price. If you just go off the framework of a macro delivering in price, you'd be sorted. Honestly, you'd be sorted. And then again, that's your fair value gap. So the macro does a rate of sell side and a market structure shift. You then wait for a retracement to a fair value gap that rests within the optimal trade entry, or within, below 0.5. So let's have a look. So it rests within the optimal trade entry, and you tap onto this order block. There you go. So that's a good one. That's a really good macro. So the way I'd kind of use that macro is like, okay, what's the order flow? Well, for the whole day, we've been bullish. We've been massively bullish. Okay, cool. So the higher time frame order flow is probably bullish. Okay. What's this macro done? What's the first, section done? It's rated sell side. We've shifted back up. The overall order flow is bullish. We've disrespected this bearish fair value gap. That's an inversion now, right? So all these things lead to going long. And then when we retrace back here, you can enter from an inversion and a bullish fair value gap and an order block. So it's like a 3 PD array matrix, if that makes sense. Let's look at the next one. And this would be a good one. This would be a really good one. I can see it. So let's go 1050. And let's go to 1110. Now here will be a good one to talk about. Right? A really good one to talk about. You might be saying to yourself, okay, well, what's this macro do? We've got a market structure shift, for example, here, right? We've got a market structure shift here and a shift here. Okay, I'm going to go short. I'm going to go short from this fair value gap. Okay. Now, you could go short from here, and you could, for example, say you went for a short position, you got filled, say here. If you put your stop above that high, yeah, you could get a partial at a 1-to-1, and you might get stopped at break even. Fair enough. But this is something that actually someone I'm talking to at the moment, one of the students is asking me about fake market structure shifts. Like, how do you know it's a fake market structure shift? Here's how. Whenever I see price do that, if I'm in that trade, let's say I go short here, which I might, right? Because you don't see this price action yet. I'm always marking out nearby bullish fair value gaps because I know we've already been bullish, right? and we've struggled to go lower. So if we're not going to go lower during this macro, and this macro is starting to deliver from this PD array, this might be the sign that we're going to start to go up again. So if I was in this trade and I hit 1-to-1 and we hit this bullish gap, I'm probably taking a partial because I'm mitigating my risk. At this point, we're in a bullish gap. What am I going to do? Bullish order flow. I'm going to measure out the consequent encroachment of that, or the halfway point, just to make it easier. So I'm going to measure out the 0.5. Have a look at it. Have a look at it. You can't make it up. It's perfect. Now, that's too perfect for my liking. So, at this point, that there's a fake market structure shift. So this actually will be an example I can add in like later on when I'm creating the PDF. That's a fake market structure shift, and you know that by this point here. When the candle closes like this or like this, you should know that that's too perfect. Too perfect. So I'd be taking a partial here or here, and if not, I'll be moving my stop to break even, and it'd probably be a break even trade. So again, this macro, you know what it does? It returns to this bullish gap, returns to this order block to continue price higher. How do you know that? When's like the final stretch? When you break above this high. That's your market structure shift. Now this, instead of being a market structure shift, turns into an internal raid. So you actually raid internal sell side. You tap into that bullish gap. Here's now your market structure shift. And this is what I call a trend continuation trade, but using ICT concepts. So hope that kind of helps you with the macros. This is like just a small thing. And we'll do one more, right? Why not? We'll go the day before. And then we'll do some London session. We'll just go to a random day. We'll go here. Why not? So let's do the 950 to 1010 macro. So this could be useful for other people too. This one's looking prime. This one's looking really prime, by the way. So 950 to 1010. This is beautiful. But this is what I call A plus macro. So we got accumulation. I love the power of 3. It's so good. That's your manipulation, and that's your distribution, right? And I believe this might have been on that day, potentially. We had a bit of accumulation here, so we'll talk about that. So what does that macro do? What does that macro do? Let's have a look. We take out this liquidity internally, accumulation, manipulation. What else does that macro do? This is perfect, right? This one's perfect. Yeah. What you just said there, Andrew, even better. Let me actually get replay mode. I just want to have a look so you guys can see. I just want to have a look what's nearby. Yeah, beautiful. Beautiful. We tapped into this. Yeah, okay, cool. So you actually revisited this fair value gap here. That's quite interesting. That's interesting. Yeah, and we swept, look at that. We swept this level of sell side liquidity too. So there you go, right? So back into the 1 minute. We've swept that level of sell side. So we swept larger time frame liquidity. We tapped into that 4-hour fair value gap. That's nice. That's what I call an A plus raid, right? And notice how you can like trust the macro, right? Most of the time. If I see accumulation and manipulation like that, and we've already taken out 4-hour sell side, and we've left all these equal highs, this trend line liquidity, I'm really wanting to go long. So that's your market structure shift. Now, do we get an entry in the macro? We don't, but here's your entry. That's really perfect, guys. And you know what also is here as well, which you might have picked up? There's also a breaker block. So for those that don't understand breaker blocks, I'll kind of make it like a diagram for you. So imagine this. So you got a high, a low, a high, and you return to this up close candle, and then I'll illustrate that on the charts. So that I'll make that blue. On the charts, your breaker block, well, that's the breaker block there, but it's this candle here. That's the breaker, that green one, right? Notice that breaker block lines up with a fair value gap. That's the unicorn model, they call it, the unicorn model. So I don't know. I think I might have made a video on this on my TikTok, but let me know. You might have taken this trade. That's a really nice one. Yeah, you've got the power of 3 to raid liquidity. You've got rating external liquidity, right? You've got tapping into a higher time frame PD rate, the macro delivering in price. I'm just going to make this green. And you've got a breaker block, and you've got a fair value gap. That's your unicorn model. So then what you do is you go long from here. You set a limit order right here at the start where they overlap. Stop loss below that low. Beautiful. You can target whatever you want. 1 to 2, right? Let's play price out. Whatever you want, really. That's like a 1 to 3, which is a solid trade there. So what an amazing trade. What an amazing day for those that actually caught that. So that's that macro. That's that macro. And that is like perfect. That is like perfect. And then we'll do the next one too. So 1050 to 1110. Again, this here, that's not a market structure shift. Because again, what happened? We returned to this bullish gap. We've already initiated bullish order flow. So I don't know how you're going to short here. I mean, maybe you saw this as an inversion. So if that was you, you saw that as an inversion fair value gap and you're using that macro. Let's say you went short from here, right? Stop loss above that high. Well, when you get back to this gap, right, I'd be taking partials, or I'd probably be moving my stop to break even. That's like a scalp kind of situation, but that's how I'd manage it. That's how I'd manage it, right? If you get stopped out and then it starts to like move in your direction, then you wait for another confluence, and this might be wrong. Then you can enter again, but you might as well like mitigate your risk. So yeah, I hope that kind of does things for you for that macro. Any questions at all with that particular macro, guys, before we move on to the next macro? Because that's really good, right? For those that actually trade the New York session, that's something I'll be journaling for sure. And look how many opportunities there are to enter. Like, that's so good. That's really, really good. Like, there's all these opportunities to go long. Like, if you didn't like this one, oh, okay, I'll go this one. I'll put my stop there. Oh, I'll go this one. I'll put my stop there. And each of them still would have yielded like a 1 to 2. So, interesting. Let's do London. Let's do London session macros. Why not, eh? So, what we might do, we'll get open a new layout. Now, here's the interesting thing, right? The London session macros are longer in time frame. 233 to 3, right? 233 to 3. Like that's the first macro, and that obviously occurs before silver bullet. And there's another one from 403 to 430. So the first one is just before silver bullet. The second one's outside of silver bullet, but it's still within the London open session. So both are still like valid, and we'll go through both. But yeah, macros good. So let's go back to this day. Where are we? Let's just go back to here really, and let's use our macros on this trade that we talked about for like an hour. Let's use our macros. Let's get our vertical line. Let's go from 233. Where are we? 233. Right, that's our first macro point. Just going to make that a bit more prominent. So macro starts there. Macro ends at 3 o'clock. Okay, what do we get there? Not too much, in my opinion, that one. Not too much, right? All I see there is that we've created these two relative equal highs, so we're generating like liquidity during that macro, which is a good point. Let's have a look at the next macro. So let's have a look. 403. Let me just get up my vertical line. So yeah, with these masterclasses, guys, like it's just a matter of, I guess, we're going through quite a few concepts. So I'm trying to tailor it to everyone. Obviously, some people are watching this going, I don't really care, which is all right. But you take whatever you want from it. Like whatever's relevant to you, you take it, right? So if you wanted to watch the whole thing, you watch the whole thing. If you just wanted to watch the market maker buy, I might watch that. Up to you what you take from it. And that's fair enough, right? So in this macro, we rally up, right? We have some accumulation. We come up a bit. But for me, all we're really doing is taking out internal liquidity, right? And guess what? ICT talked about this if you follow him on YouTube or not on Twitter anymore, but YouTube. When you've taken out previous day highs, assume the price is bullish until proven otherwise in like a larger time frame, because If you're trying to go short, right, and trying to like hold and grab the top of the market, it's probably not going to happen. So those macros for me don't do too much, right? They don't do too much. But I want to go back to the previous day. And again, this is all fresh for me. I haven't actually like used this in terms of like on my charts. So this is all fresh for me at this stage. So let's go to 233. Shift that over and let's go to 3 o'clock. This one looks pretty good, to be fair. This one looks pretty good. So let's shift that over there. So that's our macro. Cool. This one's good. What's this macro do? We raid sell liquidity. What do we tap into? We tap into a fair value gap. Do we respect that fair value gap? Yes. Beautiful. What else does the macro do? Okay. I'm just going to get my replay mode. I want to go back here. I just want to see if there's anything on a higher time frame. Beautiful. And what about the 3 minute? Yeah, okay, beautiful. So sometimes I don't actually get anything on the 1 minute or fair value gaps because I'm looking for a fair value gap here. We disrespect this one. That's an inversion fair value gap now. We've created an inverse fair value gap. And then if I go back on the 1 minute, I can implement a trade based on that, right? So on the 3 minute, when we close above it, that's too big. Let's have a look on the 2 minute, and we could use this fair value gap here. So again, we raid liquidity, tap into this, we're in a macro inversion fair value gap, we close above it. If you want to be really risky, you'd go long right here, stop loss below that low. If you want to manage risk, you'd go long right here, stop loss below that low, and you target minimum that swing high. And on the 2 minute, look at this, that's beautiful. We also return to this 2 minute gap and volume imbalance. So for those that don't know what a volume imbalance is, I'll show you. It's like a void of liquidity. So obviously, that's like your fair value gap. But notice how there's just wicks that overlap. So this here is like your volume imbalance from this candle's high to this candle's low. And it's also another PD array, by the way. That's your volume imbalance. Yep, added confluence, silver bullet, perfect. And that's your volume imbalance right here. That's quite interesting. Look what happens to price. The bodies tell the story, the wicks do the damage. The wicks tap back into this gap. The bodies stay within that volume imbalance. That's really nice to see. So what you could do then, you could mark out that 2 minute volume imbalance, and then you could go on the 1 minute and execute. Like you could do that if you wanted to. You might be like, well, why does it need to return to the bottom? Well, it doesn't have to, right? If price is extremely like bullish, it doesn't have to. And here's another example. Like look in the 5 minute. It's even more clear what happens to price. This is called a BPR, or a balanced price range. So we're talking about PD arrays now, mixing that in. Bearish fair value gap lines up with this bullish fair value gap from this candle's low to this candle's high. Where they overlap, that is referred to as a balanced price range. You've also got an inversion fair value gap there too. And if I impose that now in the 1 minute time frame, let's have a look at what happens. What does price do? What does price do? It just taps. You know what? Here's something else for those that have stayed or those that are still in. This is something else for those that are watching. Don't always anticipate or expect price to return to lower fair value gaps when there is a balanced price range. Don't expect it. We've balanced the price range here on the 5 minute. So for me, right, you anticipate this to stay open as a breakaway gap. That's what I do. If it's not going to stay open as a breakaway gap, then what do I expect or demand of the market is that this BPR, that price does not close below 0.5. So that's how you can anticipate breakaway gaps, by the way, if there's a balanced price range. Don't always expect it, right, to come back down and fill this gap. It doesn't have to because we've balanced that price range. It's a lot different if the price only came up to here and then started to like trickle. It's a lot different if that makes sense. So balanced price ranges, I love them. I like to use them. And that's kind of that macro. So that's the first one. Then let's play that out a bit. Let's look at the second macro. This is how you can backtest, by the way. And then what you do, take screenshots of all this and put that in your journal, which is good for you, right? So for those that are just joining, today we've kind of gone over, we're still going, but we've gone over time and price with an example. We've gone over the market maker buy models and sell models, right, in a bit of detail, kind of brief, but a bit of detail. And now we're going over macros, and we're going over different PD arrays that we're talking about and that we can enter from, right? So let's have a look at this macro. It looks all right, to be honest, as well. So let's draw out the lines. So we got 403. It looks pretty nice, to be honest. And we'll go 430. Cool. This is beautiful. Now, obviously, before the macro, we get this. Now, when you look at this, right, what I'm about to draw, it actually looks like this. Like, have a look. What I'm about to draw looks the same. This is when you're in a trend continuation market. Like, it's the same thing. RAID sell side, respect a gap, push up. RAID sell side, respect a gap, push up. When do we return to a fair value gap? Right about here. There's your entry from a macro. So that's how you use macros. You can use macros to enter. You can use them to see what it does. Like, it does it RAID liquidity? Does it have a shift in structure? Does it inverse fair value gaps? This is like a trend continuation model, and it's always going to be more favorable, right? It's always going to be more favorable. And what do? You go long from here, from the start of that gap. I'd place my stop below this candle here, and I'd target that swing high. Beautiful, 1 to 2 done. The other trade was this one, where you could have entered from this BPR. And even if you had a wide stop loss, well, it doesn't really matter. Go for a fixed risk to reward, you still get 1 to 2. 1 to 2 is like a sweet spot in terms of the market. So that's what I encourage. Standard deviation, good point. Great point, right? Standard deviations, I like to use them. And I mean, we might as well talk about it here. Why not, right? So if I'm using standard deviations, I mean, I'm pretty sure ICT uses the bodies, right? Some people do the wicks. If there's not massive wicks, it doesn't matter too much, right? But I'm going to mark this out and let's talk about that, right? That's one way you can project. So if you want to do a fixed risk to reward, do that. You could take partials, like say you entered here, you could take a partial at this swing high or this swing high, or you could just wait till this one, depending on what you want to do. But what I do, I grab the leg, right? Now if we enter here, we've missed the leg that created the RAID. Whatever the leg is that creates the RAID, that's what I'm looking at. And what I do, I grab the Fibonacci. I'm going to use the bodies in this case, but you can use the wicks. We'll try both. I grab that leg, right, that creates that shift from the top of that candle to the bottom of this candle. That's the leg that causes the RAID, sorry, not the shift, the RAID. And what I do in my Fibonacci settings, I just go 2, 2.5 to start, right? And I'll have a look and I'll see, okay, well, where does this line up to? Are there any liquidity points that actually line up to the 2 to 2.5? And yes, there is. So this is a really, really good point to take profit. So if you're in this trade for a long, you enter straight away from here, your stop's below that candle. Why would my stop go below that candle? Well, this is why. There's this bearish fair value gap, and that's been inversed when price closes above. So I really don't want price to close below this. I don't want that to happen. So my stop's there. If I wanted to really be risky, I could go below this candle, the one that creates the fair value gap. And then once you take out this high, that's like a 1 to 3. But doing this is more than enough and more than sufficient to get you that 1 to 2. Right? If you do that, that's your 1 to 2. So that's kind of what I'd be doing. But yeah, does that kind of make sense, Andrew? That's kind of how I use standard deviations. On this trade here, I'd consider this whole leg. That's what I'd consider. So I'd consider this as the standard deviation. I'd consider that as the leg. And where would I take my profits? At 2 to 2.5. And that's where you can expect a reversal. So see where that happens? At 2 to 2.5, there's a bit of a pullback. And then you move back up. You use this price leg, whatever raids liquidity. And that's the leg that raids that liquidity. So that's what I do. That's all I do. Now, that's kind of how I frame partials too. So like if there's no swing high that's prominent, then I can use the 2 to 2.5. I prefer taking profits at 2. Right? Obviously, this is like a perfect example. I didn't know this, right? This is the first time I've used it here, but sometimes you'll go, oh, I want to wait till 2.5. It'll come up roughly to here, and it'll reverse on you and have a pullback. And for me personally, I want to be in and out of the trades. So I'd rather take what I can and and then move my stops to break even. But even if you entered from here, you wouldn't get stopped out at break even. Depends on what your fill was. So there's a multitude of ways to approach it in terms of that. But yeah, macros, we've kind of gone through a few things today. We've gone through macros, PD arrays. I'm curious to know, you guys that are watching now, can you just put in the chat what sessions you actually trade, or what sessions you want to trade? Is it London session? Is it New York AM session? Or is it PM session? And that's correct, Andrew. Yeah, correct. Yeah, just everyone chuck in the chat right now. There's 13 people. I know a couple of people have told me already, but Aiden, cool, London session. New York AM session, cool. Who else is doing London? Because I started with New York AM session. London and New York AM session. Okay, cool. I'll answer your question in just a sec. London, a bit of both, bit of everything. Wow. Yeah, that's cool. And where are you guys from? Who's from Australia? Who's from Asia? Anyone from Europe, from the UK, US? Where are you guys from? New York AM session, PM. Cool, yeah, that's good. Malaysia, cool, nice. Anyone from the US? Poland, nice. Europe, Australia, that's right. Darwin, US, cool. Bit of a mix. Obviously, like Malaysia would be good for trading all sessions, Aiden. So I just came back from Thailand after December, and it was real good. I could trade like multiple sessions if I wanted to. Europe, nice. Canada, nice. So we've got a range of people here. That's cool. That's cool, yeah. Melbourne, nice. See, I don't know what time is it for you guys before we continue. And I won't be too long on this, but I just want to get to know you guys so I can kind of frame things better maybe in terms of the lives. Nice in Poland, yeah. 4:50 p.m. Okay, that's cool. You guys are like 3 hours behind Australia then. What about in Canada? What about in Europe? What are you guys working with in terms of times at the moment? Who's like awake now? It's like 2 a.m. There you go. I was waiting for someone. Yeah, 3:50 a.m. Yeah, that's all right. So yeah, I'll answer the question now. 3:50 a.m. still up. Fair enough. Yeah, I've been there. New York AM session for me, or the silver bullet, is from 2 to 3 a.m. So I used to go to bed at 10, wake up at 12:50. Gather my senses a little bit, and then get ready for the open at 1:30, and then trade the silver bullet from 2 to 3, journal the trade, and then eventually go to bed by 4. So I know how you feel being up. So someone asked here too, why take that exact sample size for the standard deviation on the second one? So I'm just going to get rid of these now, if that's all right, because I think we've covered that. So you're talking about this one here, are you? This one here. Summertime Australia, yeah, 100%, man. When the clocks go back, I think it's 12 o'clock to 1 o'clock. That's when I started trading the New York session. And then when it moved back, I was a bit like, what am I going to do? So I started trading London session a couple months into trading New York, because I was kind of anticipating that and I wanted to get my bearings there. But it's all the same. More volatility in New York session, but it's all the same. So yeah, in terms of this, Zarkives, I'm going to call you. I might have pronounced that wrong, but Zarkives, yeah. In terms of the reason why I chose this price swing is because this here is the swing high and this here is the swing low, or that's the price leg that creates a raid of liquidity, right? I wouldn't choose this point and I wouldn't choose this point. Now, the reason why is because a swing high is characterized by one candle having a higher high than the candle next door on this side and this side. So in that price leg, right, this price leg here, that's not a swing high because that candle's high is higher, and this is not a swing high either. So that's the nearest swing high, and that's the nearest price leg. So we had a little retracement here. We form a swing high, and then from that nearest swing high to where we take out liquidity, that's where I'm measuring from. This should be anchored below those bodies, and this should be anchored on the top of that candle, if that makes sense. So when you project that 2 to 2.5, you can expect some kind of retracement ideally in that zone, or if there's a level of take profit, then that's where you can take your profits. And after seeing this at level of 2, I'd be taking out the profits, right? Or you could hold on to the trade if you really want to. Does that kind of make sense? I can do a few more examples as well if you want me to. Standard deviations as well, guys. It's kind of like the quantity theory. They don't always work out. So for example here, I would class this as the swing high, and everyone does it different. This is just what I do, and it works pretty well. I'd class this as a swing high and this is a swing low, but another way to do it would be to class this as the swing high. So what you could do then is grab your Fibonacci, go from here to there. Now what rests between 2 and 2.5? This swing high does. So that there is where you can expect some kind of little retracement, and also where you can take your profits. If we extend that even further to like a standard deviation of 4, we don't even get there. Right, so you can kind of see how that works. That's how I'd use it for that example there. For this one here, right, if you have a bit of a look, you could class this as your swing low and this as your swing high if you wanted to, right? So for example, let's test that out. If we go from this candle to that candle, yeah, roughly about 2 to 2.5, there's a little sell side liquidity point here. That's where you take your profits. Give or take, roughly what happens there is you get the power of 3. So you get the power of 3 occurring here, accumulation, manipulation, and then distribution to the upside. So the power of 3, again, it's fractal, guys. It occurs on like the miniature time frames too. And there's your distribution. So that's where you take your profits. We don't really get to 4 before we get a reversal. What'd you say? So test different sample sizes for different swing high or low, etc., and see which one has the 2 line up and then balance. Yeah, you can do that. I prefer the most recent one. So that there's the most recent. That there's the most recent. If there's nothing, right? If there's nothing that lines up, then play around with things. Then maybe change your time frames. But personally, if I'm trading the 1 minute, I prefer using the 1 minute chart to chart this out, if that makes sense. So that's your nearest swing high and swing low. That's your nearest swing low and swing high. Let's do another one, right? Let's do another one. Let's just keep going with this. Let's have a look. So let's do this one. So technically, this is a little swing high that's formed there. And I'm just going to zoom in because you might not be able to see this, right? I just want to show you what I mean by swing high, and we'll get like this really zoomed in. So this candle here that my cursor's on, this candle, look at the top of this candle here. The high of that candle is like right here. Notice how this candle's high is lower and this candle's high is also lower. That forms a swing high. That's what's characterized, or what's called a swing high. And often the swing high has a little movement upwards, right? So I'd be classing then that move from this high here to this low. I'd be classing that as what I do my standard deviation on. That's where we rate a liquidity. So I'd grab my Fibonacci again. I'd go from the bodies here to the bodies there. What rests between 2 and 2.5, this swing high. What happens once we take out that swing high? We have a small retracement, and that's where you can anticipate a retracement. So I hope that kind of makes sense. I encourage you to backtest this, forward test this as well. That's how I use my standard deviations to get projections. It's a good tool. It's not always going to do this, but like this is just working out at this point in time. Let's do another one, right? Let's do another one. So let's go the top of this point before we start to move down, right? Before we have like a market structure shift. Right, this is the last point of liquidity rating. This is your low. So I hope this is making sense. So archives, let me know. This is your high, right? That raids liquidity, right? So that's what we're working with. Grab the standard deviation tool from this candle's low, that body high. Now in this case, we don't get a reversal in that zone exactly, but that's all right. We have a target in that zone, and it's very close. Like we get just past the 2 to 2.5, and then we start to reverse. So I'll leave it there. I hope that kind of helps. I hope that kind of makes sense for you, I guess. But I'd encourage you to forward test that and back test that. And it's good to see we've got people here from across the world. It's nice. The whole purpose, guys, the whole purpose, I started this channel in October, and I still remember the first 5 subscribers. I just thought maybe something I say people would gain some benefit from. When I first started learning, I actually had a mentor. But it wasn't what I thought it would be. Let's just say that. And essentially, I had all these questions, right? So I wrote them all down, and then I watched the 2022 mentorship by ICT. And then over time, over months and months and months, then I started to get the answers. And now I'm trying to give other people that, because I feel like if I had this when I first started, things would probably make a bit more sense. It would probably be easier to understand. I'd get more value in a shorter period of time, potentially. And this is all free. Like, I've got the Discord, right? I don't necessarily trade live like this, but I send my information in terms of what trades I take. So technically, you could say it's partially signal, but I'm always there, I'm always talking. So if you're interested in that, it's always going to be available, right? If you want the link, just send me a message on YouTube. If you've got TikTok, send me a message. But if you don't want that, that's completely fine. I'm going to continue posting videos. I'm going to continue doing masterclasses. The Discord is just more personalized, and it's like, I guess, the minute by minute analysis and thoughts as the session's happening, right? In that Discord, and if there's anyone from the Discord here, hey, we've got people that trade everything. A couple of people started trading gold. People trade Forex. I personally trade indices, but I experience trading Forex too. Because I used to trade Forex for London session only. And then when I trade the New York AIM session, I'll trade indices. So I've got experience doing both. The inverse correlations, we can talk about that one time. For those that trade Forex, I could do a masterclass one day just on Forex. Right, we could do that as well. Or we could fit it into maybe another masterclass. Yeah, well that's the plan, Grand Tour, and that's all right, Zarchives. I'm glad that kind of helped you. I like doing those videos. I've been house sitting for the last week, so I've just had access to my iPad, and to be honest, I prefer having the computer and recording the screen. This is like the computer screen. If you notice on YouTube, the videos are a bit smaller on the iPad. There might be a way to fix that. But yeah, I like to be at home and record on the screen, and I love that. I love doing that. I love talking so you guys can see, what you're doing and or what I'm doing, and my thought process. If you're here, guys, give the video a like as well. It helps. It really helps. If you've enjoyed this so far, and we're going to go for a little bit more, let me know. Give me a like. Leave a comment after. If something pops up, right, leave a comment and we can go through that as well. But yeah, I'm definitely going to do more live stuff. I mentioned before, maybe once a week going live trading. So I've got to find out where I'm going to do that, how I'm going to balance that. Probably be a similar kind of situation to this. But definitely those live executions, recording after, that's definitely going to be a thing. That way you guys can kind of see what I'm doing, right? So again, we've kind of discussed a few things here. We've gone through all of this. I'm going to make this available. I'll make it available tonight. Why not, right? And yes, at the moment, Zarchives, it's paid. It's $40, 25% off. I'm thinking in the future, I could make a free Discord, but I already have free information here for you guys. So it's different information, if that makes sense. But that's for the Discord access. You get access to, the ICT concepts, different information here, right? Different examples, so you guys can go through that. The PDFs are going to be uploaded here, right? So I've already got the ones I've uploaded publicly, but I've got also some other ones in here that are hiding, that are waiting to get uploaded. Chart snapshots, there's a range of things here, right, that you guys can look at if you're interested in that. And we've got discussion rooms too, right? So discussion rooms, people can go in there. We can discuss things. But yeah, it's $40 a month. You can cancel any time. If that's what you're interested in, go for it. If not, YouTube's always here. So I'm not going to pressure you guys to do that. I'm going to keep doing YouTube. But if you want to get in that, fair enough, go for it. A lot of value then. I'll spend a lot of time. I'll be honest with you, I have spent a lot of time developing all this stuff. Like all this stuff here, heaps of time. All these concepts, like 1, 2, I think there's about 20 concepts. This all here is like a summary of ICT in the 2022 mentorship, like different ideas. So once I went through the mentorship, I came up with like a bunch of ideas, and this is what it is. But yeah, this is just like a bit of a sneak peek for you guys, just so you can kind of see. And everyone helps each other. Like we're all there when the markets are on, right? We're helping each other. When's this? This was that example I showed you at the start, guys. So that's when I called it out to the Discord, 524, and you can see what happens. So I'm calling things out. I'm not necessarily trading live, but it's very similar. But that's where I'll kind of leave that. So if you like this video, guys, give it a like. That would really help. I think we've been going for like an hour and a half, to be honest with you. Are there any more questions, like final questions? I'm happy to stay on for like another 10 minutes or so. But if you have any more questions, let me know. Send them in the chat. And we can go through them. Discord, again, that's there. I'll post this up on Google Drive. No worries, Grand Tour, yeah. Keen to do this again. Andrew, I'll read your question now. Right now we have new time highs for NQ. Do you recommend trading or just waiting for more structure? Let's actually have a look. Let's have a look at the daily chart. Why not? Because I got to do this anyway at some point, so we'll go through it. And we'll talk through your question too. Now, we have actually come quite high, right? So we've just taken out liquidity. Now, one thing I learned from ICT in the mentorship is when we take out important liquidity on like a daily time frame, like when we take out daily or weekly liquidity, we do one of 2 or 3 things. Number one, it's 2 things really. Number one, we push past it and then we accumulate. Number 2, right, we reverse. So what could happen doesn't have to happen. I'm not trying to, predict the market. We could just accumulate a little bit here, not do too much, right? That could happen. That's a possibility. Another possibility here is that we reverse the next day. So we reverse the next day. Let me just change this. That's a bit all over the place. But we could reverse, right? And pull back down into this range. That could happen too, right? And yeah, depending on obviously what you trade into, right? This is the NQ chart. Let's have a look. And I just want to get up as well because some people trade this too. Some people trade the NAS 100. Similar kind of thing. For me personally, I used to trade NAS 100. I'm just looking at NQH. That's what I trade on. NQH March contract, yeah. So a couple things could happen. To answer your question, do I recommend trading? I'm still going to trade, right? Would I prefer taking buys? Probably. Probably I would. And let me just have a look on the weekly chart. Am I missing something here? So weekly is looking interesting too. It's actually interesting to see what's happened in different seasons as well. Let me know, Grand Tour Bear. Let me know what you're talking about there, just so I can get it up. But yeah, I'd be looking for longs, ideally. Doesn't mean I won't take a short. You might see this week when I post some live stuff, I might take a short. It just depends what the markets are showing me. Also, I've started a Twitter. The Twitter is called Full View Trading, right? I'm going to start to post on there as well. So I'm going to start a few things. I'm going to start a Twitter, which I've done. I'm going to be starting a Telegram account, right? Cool, yeah. Cool. yeah, I'm going to start a Twitter account like I've done. I'm also going to start a Telegram account like I told you guys. That is going to be just for posts and reviews. That's all it's going to be for. So for example, like if I take a trade, whatever it is, win, loss, I'm going to post there. Also important, which you might find interesting, I'm going to track and journal all of my trades, right? All of my trades. I already do, right? But I'm going to track and journal all of my trades. I'm going to make an effort to do it. I'm going to make an effort to record all of them, whether it's the iPad or whether it's, on this screen here. And what we're going to do is I'm going to create, a collation of videos just illustrating what you can do. Risking 0.5%. Nothing crazy, 0.5%, one session, and that's it. Once I've done that for 2 weeks, then I'm going to upload a little series, or maybe once a week, I'm going to upload a little series on YouTube, going over all those trades and kind of talking about how I felt in those trades, etc., 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 whether it was a win, a loss, how I mitigated that, how I ended the week. That'll keep me accountable, but also for you guys, you can see, how does it work? How does the process work? So I'm going to start doing that. So there's a lot coming to the space. There's a lot of free information coming both to the YouTube, Twitter, and also Telegram. YouTube is the main education platform. TikTok as well, right? TikTok as well, but TikTok's really tricky. It's too tricky to post long form videos. So for me, TikTok, I'm going to continue doing market reviews on the sessions, right? London and New York a couple times a week. YouTube, expect similar videos, right? And I'm going to aim to do 2 this week or 3 live recorded trades. I do want to save some though. So that's kind of what I'm aiming for. But at this point here, it's very hard. I'm not trying to predict where the market opens, but I'm waiting for the market to show its hand, right? If we do pull back down, if is the question. Obviously, there's this, this bullish gap right here. That's your next draw on liquidity. If we go higher or new territories, just on this time frame anyway, looking in this time frame. So I hope that kind of explains it. I'm the same as you at the moment, Zarchives. Or was it Andrew? Yeah, Andrew, I'm the same as you, man. Like, I prefer if we're here because we've got points of liquidity to target. You know what I mean? When we're here and there's nothing to the side on the daily chart, it's tricky. The same applies if you're trading on the 2 minute, 1 minute chart and you're looking at the chart and this could be like your 2 minute chart. Like, what are you going to target? If there's nothing here, it's really tricky to manage, but we'll wait to see what Monday does. Will I be trading tomorrow? Probably. It just depends what the Asian session gives me. If there's nothing too clear, I might not trade it. I might do some tape reading and I'll record that as well so you guys can see what I do there. But I think I'll leave it at that. Any more like final questions, guys? Or is everyone all sweet? Hopefully you guys got something from this. I don't know if someone's joined now or who's been here for the whole session, by the way. Who's been here for the whole session? Has anyone been here for the whole session? I know a couple people have just kind of joined in here at the end. Yeah, that's right, no worries, yeah. Again, my inbox is open. TikTok, if you got it, cool. YouTube, obviously you got it. You're watching the video. You can't send a direct message, but comment, give this video a like, guys. Give this a like. Don't worry, man, don't worry. It'll be uploaded, it'll be recorded, and you can rewatch it, don't stress. Give this video a like, guys. We've got 1 like currently, I think. Give it a like. And yeah, like these things, like this is a bit of a longer one, but I could keep going. So I don't want to keep you guys here. I could keep going. It's 8 o'clock now. I've got to have some dinner too. But I could keep going. So once I get talking, and the more value I provide, the better. Depending on your level of knowledge, some things might be confusing. But if it's confusing for you, send me a message. 21 likes, cool, beautiful. Appreciate that, guys. Appreciate that. And we've been growing too, right? So for me, it doesn't matter about what the Discord's doing. This is always going to remain, right? Because I like this platform. I like engaging with you guys, and I like going live too, so you can see it. and you can kind of ask me questions. Otherwise, I'm kind of making my own things. But again, we'll leave it there. 2 hours. It's been a good session. Bit of an echo at the start, just a warning, right? So I might try and edit that video maybe before it goes live. If not, it's just going to go live. And I'll talk to you guys when I talk to you guys. My inbox is open. When I get the Telegram open, I'll put that link as well in YouTube. I know a lot of people use Telegram. You can message me on there, and I'll get back to you as soon as I can. But yeah, until next time, guys, I'll talk.